Welcome to MGK. We will be playing our first game on our new founded television show. We were originally a banking business and decided to expand our brand. What better way to do that than creating a fun, interactive, and educational game show?
Hello, I am Kelsey from MGK Banking. Today, in honor of our newfound television show, me and my third partner, Melanie, will be competing in a game show on monetary policy.
Yes, I'm ready, and I personally feel like I'll win with ease.
We'll see.
Well, it looks like we have a competition. Before we start, who do you think will win? To begin with Essential 1 of monetary policy, what is monetary policy and the act that gave the Fed the power to conduct monetary policy?
Monetary policy is the action of the central bank that influences how much money is available in the economy and how easily people can get loans. The Federal Reserve Act of 1913 gave the Fed the power to conduct monetary policy.
Correct. Next question, why does the Fed conduct monetary policy?
To lower prices?
Wrong. Kelsey, can you answer the question again?
Yes. The Fed conducts monetary policy to achieve economic goals such as price stability and achieve maximum employment.
And that is correct. Moving on, what is the structure of the Federal Reserve?
The structure of the Federal Reserve goes from member banks at the bottom to district reserve banks, the Board of Governors, and the chair at top.
Correct. Explain the part of the Federal Reserve responsible for conducting monetary policy.
The Federal Open Market Committee is responsible for conducting monetary policy.
Before we move on to Essential 2, what have you learned from Essential 1? Do you think you have a better idea of what monetary policy is?
What does FOMC stand for?
FOMC stands for Federal Open Market Committee.
Correct. What is the role of the FOMC?
The role of FOMC is to set monetary policy for the United States.
Okay, next question. Explain the structure of the FOMC.
The FOMC consists of 19 members, 7 governors, and 12 reserve bank presidents.
Correct. How often does the group meet and how frequent?
They meet every 6 to 8 weeks in Washington, D.C.
Next question. Which FOMC members vote on changes to monetary policy?
Only 12 members vote, 7 governors, 5 reserve banks, the New York president, and 4 others who rotate are the ones to vote on changes to monetary policy.
You're missing an important detail. Kelsey, do you know what it is?
All reserve bank presidents participate in FOMC policy discussions, whether or not they are voting members.
Enjoyed the episode so far, and are you still rooting for the same person who you were rooting for in the beginning?
Explain the concept of open market operations.
Buying and selling U.S. securities on the open market.
Correct. Explain the term securities and give 3 examples.
Okay.
Who's that?
Wait, defined broadly to include a wide array of investments such as stocks, bonds, oil, and gas interests.
Correct. What happens when the Fed wants to increase the money supply through open market operations?
The Fed will purchase bonds from banks to increase money supply.
Correct. Explain what happens when the Fed wants to decrease the money supply through open market operations.
The Fed will sell bonds to banks to decrease the money supply.
And that's correct. Moving on. What are the reserve requirements?
The amount of money banks keep on reserve at the Fed.
Correct. Next question. How do Fed decisions impact reserve requirements for banks?
The Fed adjusts the portion of total deposits that banks must keep on hand in their vaults. This will impact bank operations.
Correct. Give an example of what happens when the Fed sets higher reserve requirements.
Higher reserve requirements equal more money in circulation.
I'm sorry, but that's not correct. Kelsey, could you have the answer correct?
Higher reserve requirements equals less money in circulation.
That's correct. Now give me an example of what happens when the Fed sets lower reserve requirements.
Lower reserve requirements equal more money in circulation.
And that's correct. Explain how discount rates work.
The interest rate changed by the Federal Reserve to banks that borrow on a short-term, usually overnight basis.
That's what interest rate means, but that doesn't explain how it works. Melanie?
The FOMC decisions control the discount rate, the rate of interest that the Federal Reserve changes member banks for short-term, overnight loans that allow banks to borrow because they are the lender of the last resort.
Correct. Thank you. Explain how the discount window works.
Allows banks to borrow money from the Fed to meet temporary liquidity shortages. Liquidity is money.
Thank you. May I get an example, please?
An example would be the Fed rate because 1% of discount rates equaling to 2%.
Okay, this is our last question of the day. Explain how the Fed is the lender of last resort.
The Federal Reserve or other central banks typically acts like the last lender of the last resort to banks that no longer have other available means of borrow and whose failure to obtain credit would dramatically affect the economy.
And that's correct.
Did you enjoy? If you did, we'll see you in the next season.